Those out there who aren't aware of me, my name's Chris Weston. I'm head of research here at Pepperstone. I've been with Pepperstone for a number of months now, and I've been in the industry for about 18 years in terms of finance. I've worked at some of the big investment banks, Merrill Lynch, as a fixed income money market trader, doing some currency overlay as well, some trading there. Just before the GFC hit, before I moved out to Australia, I've worked with Merrill Lynch in an equity trading role, and also with Morgan Stanley as well in an equity trading role. So I've traded most products, and certainly as a trader who trades on my own account through a broker, I have traded pretty much every product there is in terms of interest rates, FX, predominantly FX and interest rates, some fixed income, some index trading, and some commodity trading as well. I tend to sort of shy away from individual stock names. And the objective of the webinar program that we're going to be doing now, I'm sure you've seen some of the webinars we put out from FX Evolution. I'm sure you've seen some of the webinars that we've done with BK Asset Management. But I will be doing a series of webinars going forward. I think probably the logical place to start with this is to lay the groundworks for a trading plan. You know, we see traders coming through the doors who, you know, are either well-established traders who still can learn a few things here and there, or you know, less established traders, people who are really new to trading, and just so you know, hear this idea about a trading plan and say to themselves, yeah, what is a trading plan? People talking about the psychology in trading, how they can manage their emotions, but until they actually have a plan in place, you know, it's very, very difficult to say that. So they need to start from the very basics. So we will be going through into some webinars on a more regular basis, looking at strategy, things like pairs trading, how to trade sort of macro views using currency pairs, how to scalp markets, all these various factors. But I think the first logical step for me is to really define the trading edge that we have out there. You know, how do we get an edge over the market? As retail traders, you know, it's very difficult to get an edge, and the edge that you have will be different from the edge that I have, and that's going to be very specific to you as an individual person. Okay, I'm getting a few people saying the audio is very poor. I'll try and speak a bit louder, and if it's really bad, then I might have to go through the phone line, which might take a couple of moments. So we're just using the audio through GoToMeetings at the moment. Yeah, well, I'll crack on and get a few people saying it's okay now. That's good. Anyway, so we're back to creating an edge, right? So we're looking at the sort of the three-part approach to this, which I think is one, just looking at the first phase, which I think is important, is looking at, you know, some of the things that I've learned over the years, in the sort of 18 years or so of trading. And just some of how these can apply to you, you know, some of the tidbits that I've picked up along the way. Then what I'm going to do is going to look into the second focus, which is 10 essential steps that you should be asking yourself. Now, this is not considered personal advice. Nothing I'm going to say here is you can take away as personal advice. I'm allowed to give general advice on market moves, and I do that on a daily basis. If you're not subscribed to my daily fix email, which has a video and talks about daily moves, and we're going to have trade ideas in there as well, please do subscribe to that on a daily basis. I'll put the link on at the end, but you'll be able to see the questions that I think every single person, whether you're brand new to trading financial markets, whatever that instrument is, or you're more established in the market, and you think that you've got a bit of a defined plan, but these are still things that you should definitely be asking yourself. And then what I think I'm going to do is I'm going to go over my process, what works for me, you know, how I create my edge to profitability. So I think, you know, just talk about some things that I've picked up over the years. Then we'll talk about things that you should be asking yourself to develop a trading plan. And then I can give you an example of how I actually think about the world, and the way that I think about things going forward. So that's the structure for today. And I think first of all is the idea about asking yourself is having looking at these sort of tidbits. And I've labeled this slide continuous improvement being essential. Now that is something that not enough people do. And you know, if you go back to any kind of hedge fund and how they improve as traders, be it discretionary traders, probably less so on the systematic side, people who are using computer programmers, you know, algorithmic trading, but more people who are trading on a discretionary basis and perhaps using a technical overlay, which is kind of how I think about the world. These people will submit all their trades. They will have a trading coach who will go over their trades to see exactly what they're doing wrong, what they're doing right, what they should be doing more of what's working, cut back on what's not working, and is it the markets themselves that is creating the distortions in their trading. So for me, being able to improve as a trader is something that we don't see enough of. But it's something that professionals do. They're always trying to learn. They're always trying to get better as traders. What is their edge and how I can define that edge. And once you understand that, then you're on your way. But when you're starting off on this journey, your first job is survival. There's absolutely no doubt about that. Your job is survival until you can get to a point where you find and thoroughly understand what works for you and what doesn't. So for me, and this is a really question that is specific to myself, because part of my job is being a strategist and trying to devise playbooks for clients and also for myself around macroeconomics events that are playing through, thematics that are playing through in the market. I believe that markets trade in cycles. Now, if we've got a short-term focused event coming through that changes the macro picture. Let's say we've got the Brexit scenario playing out, and people are looking at the chain of command, which creates volatility in financial markets. Now, I think the hierarchy above everything else is politics. Politics changes the fiscal outlook. It changes the need for consumer behavior, business sentiment, business confidence. And then subsequently, there's a reaction from the central bank as a result of changes to financial conditions. So the very echelons, the very top end of what's going on is politics. Politics, then central bank actions, and then we've got sort of small intra economic data which can change the perception of what a central bank's going to do. But I understand the chain of what creates volatility. And my job as a strategist is to really understand where we are in that cycle. We're the stage one of a cycle where people are all starting to understand what the event could be, what could happen at the event. Let's take the Brexit scenario as an example. That's a very difficult one to portray because they've got to get a deal together, and when there's a deal actually cobbled together, they need to pass this through Parliament. But at the moment, we're seeing trends develop in the pound. We're seeing the pound developing a strong uptrend against the euro. So euro pound going lower. People have been getting excited that we are going to get a deal. That sort of pared back a little bit recently. And then you have that sort of 24-hour, 48-hour around the event itself, where you see heightened volatility. You see stocks going off. You see liquidity conditions deteriorate. And then you have the aftermath, where everyone starts thinking to themselves, we've got this deal out the way. We've got this situation out the way, and now what does this actually mean going forward? So I like to think about things in a three-stage process. How do we trade this going up until the event? And I think that's probably the best place for me to trade. What happens during the event itself around this specific date that we have? That's probably the low probability time because the volatility is very, very high. And then we've also got the aftermath, where everyone comes together and says, this means this, and then you see these trends developing as well. So that's my job as a strategist, is to really understand the different permutations of event. We've got the non-farm payrolls number coming up, hypothetically speaking. What is it that we're looking for? We're looking for the wage growth. We're not so bothered necessarily about the actual number of jobs. What does it mean? If we get wage growth above 3%, we're going to see the interest rate markets move and the US dollar is going to rally. What's the best currency for me to be long? Well, probably we're going to see it most sensitive against the yen because we get carry trades going through there. My job as a trader is very different. My job as a trader is to react to price move, to manage risk. Your first job as a trader is to manage risk. You are a manager of losing trades, a wise one told me. And that's really where we are. So we need, for me, specifically, the understanding of the difference between trading financial markets, reacting to price changes, reacting to flows, reacting to moves in volatility, and managing the risk that's associated with that. Trying to get as much out of a specific trade as I possibly can to increase my P&L, and not trading my P&L. If I'm making money, I'm not taking my profits off the table just because I'm making money. Moving my stop up to break even just to lock in a profit. I'm trading the market. I'm not trading my profit and loss. I'm trading the market. So having a clear understanding and differential between being a trader and being a strategist. The strategist, you know, you can put out a view, but you can't, you're trading in and out of that view. So that was a really important one, that a lesson that I've learned over time. Traders will fail because they will not improve. And as I talked about earlier, you know, for me, it's the main reason why people fail. It's because they're just not analysing trades. Now, the best thing you can do is go out there and get a trading journal, be it one that you buy or sit there with an Excel spreadsheet and map out the trades that you do. Once you have a decent sample of data, you can spend a bit of time on a weekend, and that's what I tend to do. Have a look at your trades that have worked. What did you do that made them work? You know, is there a certain currency pair that you've traded really well? Was there a time of day that you traded really well? You know, we have people that don't like to trade on certain days because they have, you know, they've looked back over a decent sample of data and said, well, I just never make money on a Tuesday for some reason, whatever that may be. Maybe it's turnaround Tuesday, and you're tending to trade trends in markets and momentum. You know, shy away from these things. Find out what works. You've got to document that. You've got to have a look at your equity curve, and you've got to understand how you are feeling at that one time, and is there a certain trend that you're following? And you know, the best thing you can think about with trading is think about how you work in your life. If something's working, you do more of it. If something's not working in your life, you do less of it. I love Vegemite. I'll eat it as much as I possibly can. I don't like stubbing my toe. I'm going to try and avoid stubbing my toe. You know, these little things in your life, if you can do that in trading, you'll do more of it. But you know, trading is one of those things where we just don't listen to these rules, and we tend to see people making the same mistake over and over and over again. And why is that? It's because they're not documenting it. They're not taking the time to actually go through analyzing their trades and doing more of what is working. Yeah, sorry, Joe, the sound's not working for you. I will definitely send you the recording for this. I apologize for that. Yeah, so just find out what's working and really document that. So that to me is why traders ultimately fail, is because when they're getting to a point where they're getting a strategy, they're actually not honing in on what's working and doing more of what works and cutting back on what doesn't. Know and respect your competition. Now, if you're a currency trader, who is my competition? I think certainly in the equity market, your job is to take money from other people. Your job is to, you know, take the most capitalist approach you can possibly have out there, which is you've got to distribute wealth, and you're the man or woman who is taking money off everyone else. Your job is to grow the capital in your account and manage the risk around that. But your job is to take money off everyone else. You know, that is really how it works. But in the FX market, things are very different, and you've got to understand who the players are out there. You know, it's not everyone's speculating on outcomes, and that's the very difficult situation. If you think about the equity market, you think about the fixed income market, there is a categoric fair value in the market. You are taught, you know, when you go to finance school, that the price you pay is the right price for a stock based on, you know, the expected future cash flows, and if you discount those future cash flows using a discount mechanism, which could be anything really, but certainly as analysts you create a discounting mechanism, but you discount those cash flows back to the present value, and you're given a net present value for a stock, and then you can work out whether the price is cheap relative to the next present value. And of course you can also be a momentum trader, a trend trader as well, and you're buying high and selling higher, or you're selling low and selling lower, or buying back lower. But in the bond market, you know, there's a realistic fair value as well. You're discounting the future principal and interest and the cash flows that are associated with the income. But in the FX market, there is no one fair value. And we're talking about flows that are moving around from one place to another. So think about who's actually your competition. Think about how those capital flows manifest on themselves. Think about how those capital flows are actually working out. So you've got leveraged funds. You've got the people who are, you know, borrowing capital, your hedge funds, your commodity trading advisors. These are the guys who are speculating on financial market moves. They might be coming out and trading because of momentum in a currency position. They want to buy the strongest and sell the weakest, and hope that momentum continues going forward. We might be talking about trading volatility. They might be looking at trading carry. where, you know, dollar yen's a really good example of a carry trade at the moment, where you've got the low yield of being the yen and the high yield of being the US dollar at the moment, and looking to be paid to be in a position. And of course, in that situation, the market conditions are really interesting because, you know, in low volatility environments and positively trending risk, you know, credit spreads are contained, equity markets are trending slightly higher. People want to be paid to be in a position. Of course, carry works really well. So you've got these funds, the CTAs, which are following trends in markets. They might use moving averages within a fairly complicated system. But these are your competition, you know, the hedge funds, the leverage funds, which we see in the CFTC data every week. They're moving money around, they're speculating on outcomes. But then you've got guys who are not necessarily speculating, your export companies, your real money accounts. Now, real money is unleveraged accounts, your asset managers, your insurance companies, your endowment policies, funds. You know, all of these guys are not necessarily speculating on moves, but they might want to go and hedge a portfolio of gilts or portfolio of stocks. And you may use a currency overlay manager to do that. So think about how capital is moving from one place to another, because ultimately that is the FX market. You know, capital flows going from one place to another. We have reserve managers as well, reserve managers who act on behalf of central banks. You've had the Chinese PBOC who have been using their currency reserves to try and actually prop up their currency, and you know, they use a reserve manager to actually use those flows. So I think it's really important, you know, as a currency trader, to understand how capital is flowing from one currency to another, what's propping up euro dollar, what's selling Aussie dollar. It's not everyone speculating. And these are your competition. When you're trading currency markets, you're looking at all these different players and how capital is moving around from one place to another. That's why currency trading is really hard, in my opinion. We're not just taking a view on what's going to happen with the Reserve Bank of Australia. We're not taking a view necessarily on how Brexit plans out, because there's all these other people who are moving money from place to another. So I'm going to talk a little bit about why I don't think fundamentals are done correct, is used correctly in a moment. Successful traders fine-tune a process. They judge themselves on the discipline. Now that is so incredibly important. You know, the amount of times I'm part of a WhatsApp trading group with people, various different WhatsApp groups. I'm part of different trading societies with, I'm sure everyone in this room is in a similar sort of boat as well. And the amount of times when people come back and say, I had a really, really good trade there, you know, I just made X on this trade. And I think to myself, well, that's fantastic. You know, congratulations. I like it when I hear people making money. But, you know, patting yourself on the back and saying I've made a really successful trade is not how successful or professional traders judge themselves. They judge themselves on, how did I identify a trade? How did I do the correct position sizing? How did I manage the risk? How did I actually process the trade when I was in the trade? And how did I execute the outcome? How did I extract the most juice out of that trade? And when I've done that, I've documented it, and I've actually followed a plan, and I followed a process. And they will judge how successful they are based on that process. One of the first lessons I was taught when I was trading in London was, if you come back to, my manager said, if you come back and make, you know, 20% on a trade, but you've done it in a reckless fashion, I'll sack you. And that's really the epicenter of the whole situation is that you can make as much money, but if you've not followed the process, then you've been unlucky, or you've been lucky in that situation. You know, if you've lost money in a situation, this is kind of like how turtle traders think about, the turtle traders thought about it, is being taught a process. And if they lost money, that was never a problem as long as they did follow the process. So we need to have a step-by-step process that we think about each and every trade. We need to go back once we've made that trade and actually say, yeah, I stuck to the rule. And a successful trade is a really top-end trade where you're making 10 out of 10, is when you actually say, well, I stuck to my rule, I stuck to my playbook, and I've made money, and I've managed the risk like an absolute ninja in that situation. And that is a successful trader. That's how they do it. Have I followed a process? Not going, yeah, I've made 5%. Fantastic. It's always good to see, but how have they followed the process? Respect any trader with an edge, regardless of their style or methodology. So, you know, I hear traders coming up to me and saying, yeah, I follow GAN, and, you know, people are talking about, you know, the clouds are aligning, and you know, this is happening, and then, you know, this weather pattern is doing this. And that's fine. You know, people obviously treat that with an edge of cynicism. But I don't think that's the right way to do this. Now, I think, as you say, if you've got a process and you're following whatever it's going to be, whether it's Ichimoku, whether it's discretionary trading using pure fundamentals, if that person has an edge, if that person can come to me and say, if that person can come back to me and saying, you have followed a process and your equity curve has done this with limited amounts of drawdown, and you've managed that drawdown in a really particular fashion, regardless of whether you're talking about the clouds aligning or whatever that strategy is, you've got to respect that. That person has an edge. And I hear way too much cynicism about people who have got these kind of weird and wonderful strategies, but actually are making money and they're actually managing risk accordingly in that situation. So I do. I think we should always respect people, whether you're using technical analysis and you're looking at risk reward and probability in trading, or you're doing something on a more fundamental level. I think you should always respect people for their style, as long as they do have an edge and they're following a set process. I think you can respect people in that situation every time. Understand, respect, and harness the role of the media in training. Now, for someone who looks at the order book and has a look at the supply demand dynamics that are playing through, the media can really shape just how things are going, and they can control, though their job is at the end of the day is to sell fear, but they can also have a key role in creating euphoria as well. So understanding how that works, because you see a situation where markets are in free fall, they love calling in saying, Chris, this market's dying. What's going on? How much further can it be? And if I come back and say, oh, we've got another 20% downside here, they're loving that. They're like, Chris Weston said this, but the role here is that you've got to cut through the noise, because the media can control the order book dynamics. If there's heightened volatility, the implied volatility in markets is elevated. People are looking around for answers. What's the circuit breaker to cause to stop the downside move? And they can't see that. I mean, look at what's happening in financial markets at the moment. We've seen the S&P, the Dow, and US markets having a really strong pullback. The VIX, the implied volatility in markets, has gone up to above 20%. And people are asking me, what is exactly causing that move? And I say, well, okay, we've got higher real bond yields moving up. We've had a steeper curve. Interest rate markets have been moving up. Economic growth, as some people are talking about concerns around economic growth, given the PMI numbers, but the Fed is still really willing to push rates up higher than where they are. We've got a lot of systematic traders who have had to reduce positioning very, very quickly as a result of the implied volatility going up. This is all sort of clutching at straws type situations, but there's a lot of questions being asked, and then people are not getting a lot of answers. What does that actually mean? Well, it actually means that you're not going to go out and buy this market with any real conviction if the volatility is high and we can have a 2% move in these equity markets very, very quickly, and the media is selling this idea of fear. It's going to keep the bid dried up. You're not going to go out and buy. But there's I think people are getting a bit of background noise. I apologise for that. I can't really, unfortunately, we'll have to try and sort that one out. But there's actually no one here, so I'm not sure where that's coming from. So we're looking at the role the media plays in the sentiment and how that feeds into the order book dynamics. Is there enough panic out there to keep the buyers away? And is there a lot of selling that's going to take place as a result of the media? So think about the order book dynamics and how that plays into it. Try not to listen to perma bears and perma bulls. Now that's really interesting, because there's a lot of people out there. I'm not going to name any names, but certainly I spend a lot of time on Twitter. Great, thanks guys. I'm hearing there's not noise from our office, so that's good. Thanks for the feedback there. So try not to listen to perma bulls, perma bears. I think that just plays with your psyche. I think there's a few guys I follow on Twitter, and they're just constantly looking at the negatives in everything. The world's going to collapse. There's student debts doing this. The Fed are going to raise rates way too aggressively. All these various factors. The market's at all-time highs, or was at all-time highs on the S&P and the Nasdaq and the Dow. A market at all-time highs is about as bullish as you can possibly go. I can't really construe it any other way. But yet everything was trying to search out the negatives in everything that happened there. Now, imagine how much wealth destruction is caused as a result of that. People not wanting to be in the markets, people who are easily swayed by this situation. I'm not going to name any names, but people read these columns and they're saying, there's going to be a 50% crash in there. The emotion that creates, the emotion that creates, and people are saying, I'm not going to get in the market, there's going to be a pullback. So you get this asset price deflation mentality. We're saying, I could buy at lower levels, and so when you get people who are constantly bullish and constantly bearish and trying to pick out the one piece of negative news from 10 releases, that's cool, Peter, thanks, mate. Then they mess with your psyche, and it stops you doing what you need to do. It stops you following your system. So for me, it's just trying to keep these people at bay and trying not to mess with my head, not to change the perception of how I'm doing things, messing with my system, and they will do. There's absolutely no doubt in my mind that the perma bulls and the perma bears, if you listen to them enough, will keep you away from markets. Question that we get a lot of is demo accounts. Do they have a place in trading? Now, they absolutely do have a place in trading, in my opinion. The clients that we see coming through the doors who are really, really green to markets, I think it's a really good chance to understand the first layer of trading, which is obviously understanding the platform, understanding how to place a trade, how to understand the leverage that's in the markets, because obviously FX trading carries a large degree of leverage. So you have to understand how to place these trades correctly, get that position sizing in the market, and also understanding a little bit about the characteristics of a currency. And we'll talk a little bit more about that in a moment. And actually just honing that strategy in play. So I think a demo account really does have a place, but it has to stop at some stage, because there is a huge difference between placing paper trades and having real skin in the game. So I think the question is more, can you actually make money with a $500 account, or do you actually need more in that market? So having a demo account is great to get to understand MT4, get to know CTrader, get to know the platform that we offer here at Pepperstone. But once you've understood how to implement those strategies, you absolutely need to put money in the account, because having skin in the game, and I work for a broker, so of course there's going to be a bit of cynicism about that, but having skin in the game is so much different. You're going to be waking up in the night, having a look at your positions. You want to manage that risk at all times, and things get real. Having skin in the game, things get real. The problem with having a $500 account over time is the lack of discipline that people have. People think in percentages. So when you actually have $500 in your account and you make, $10 because you're taught you have to put 1% of your portfolio down or 2% of your portfolio down on each trade, you start off with really great intentions and you make $10 here, you make $15 there, you lose $5, you lose $7, and then things start changing a little bit. You start having a win of losses. You might you start having a positive run streak. So maybe you get 7 or 8 trades in a row, and then you start saying to yourself, I can't work on this $10 anymore. I need to move higher. I'm invincible almost. So you get people pushing, doubling their contracts, tripling their contracts, and then suddenly you have a bad trade, because eventually, you are working on a random event. The market is random. There is, unless you're insider trading, the market is a random set of events, and you need to manage that randomness. So invariably, if you have a run of wins, the time when you increase your position size and go against everything that everything you've done really well so far, would be the time you do 5 contracts of Aussie dollar, and the market has a 2% move down overnight, and you've just blown up half your account, and of course then it's too hard, and that's when you start thinking to yourself it's not for you. So that's the problem with a $500 account. I think it's really great that you have skin in the game, and you're understanding how the markets work, the characteristics, how volatility impacts your position. You're actually got an open position, and you're doing trade management, which is so important, which I'll talk about my hierarchy of trading needs in a moment. But the problem with $500 accounts is that you invariably will have a run of winners. And it's when you have a run of winners that you start moving and changing that discipline. I'm going to trade 2 contracts instead of my usual 1. I'm going to risk 5% or 10% of my portfolio rather than that 1% that we've been categorically taught. And that's when you lose half your account size and you start chasing your returns, and everything goes out the window, and you say, oh, it's only $500. So for me, A demo platform is great, but nothing beats skin in the game, and nothing beats having a reasonable amount of money in the account. And I know I'm saying that as a broker, but the way that you can actually control that discipline is certainly significantly higher if you've got a reasonable amount of capital in there. So treat trading like a business. Once you've actually got a routine in place, once you've got a program in place, treat it like a business. Now, I'm not going to go and open a pizza restaurant in Lygon Street if I don't know that my pizza is better than everyone else. I know the costs involved with doing this. I know what my edge is. I know why people are going to keep coming back to my restaurant time and time again. I know what my edge is in that situation. I know the costs. I know, how my staff are managed. All these various factors that are involved in running a business. And to me, trading has to be thought of in exactly the same way. Okay, trading FX using pure fundamentals is seldom done correctly by retail traders. I very often have phone calls with clients who are saying, "Oh, I'm going to buy the Canadian dollar tonight because the Canadian Central Bank are going to raise rates." Great. Okay. What do you think about the interest rate curve out the next couple of years? What? What do you mean? I have no idea what you're talking about. Okay. Well, let me tell you that the probability of a rate hike tonight is 100% priced in. Every single analyst has got that. And you actually see a situation where the Canadian dollar actually fall when you get an interest rate hike, and you're saying to yourself, well, it was all priced into markets. So, that conversation I have all the time. I'm going to buy the US dollar because the Fed are raising rates. Well, there's obviously a huge amount of logic to that. They are, the standalone island. The US economy is doing very well. There's fiscal measures being put in place, and the Fed are certainly on a much more aggressive path than everyone else. That said, I will look at the interest rate curve, and I will look at actually it's what's priced in, and I will make an assumption about how much more hawkish they can be in. And then I say to clients, are you actually looking at interest rate markets? Are you looking at bond markets? Are you looking at terms of trade? Are you looking at implied volatility? Are you looking at these various factors? And they're like, no. And if I give you some examples, I talk to clients who say, well, iron ore's going up at the moment. So if you look at the left-hand chart, I've overlapped the Aussie dollar, which is in orange, and the Citigroup's terms of trade. This is Australia's specific terms of trade. So we are looking at things that are really important to the government revenue numbers, things like iron ore, copper, gold, and subtracting the imports against that. So the terms of trade, and you can say terms of trade at this point in time, on the 24th of October, is that terms of trade are actually the highest level since 2014. Now, for a large period of time, there is a reasonably strong correlation directionally between the Australian dollar and the terms of trade, and that's fine. But correlations come and go, and at some stage, we were looking at iron ore, we were looking at copper and gold, and saying to ourselves, well, if this keeps going up, the government's going to be making more money, this is going to be inflationary, and it's going to be great for growth. And of course, the RBA are going to have to react more aggressively in that situation. So the correlation was there, but as you can see from basically the beginning of the year, when we've seen this beautiful downtrend in Aussie dollar, that the terms of trade have absolutely mattered little. In fact, there's actually an inverse correlation between the two. If you were to do a regression between the two for the year, you'd actually see that the iron ore in the terms of trade explains no variability in the Australian dollar whatsoever. It's been driven by other factors. Those factors, which you can see much more closely right now, on the right-hand chart, is the correlation between the Australian dollar and the JP Morgan Emerging Market Effects Index, which they weight the various effects currencies, such as the Chinese yuan, the Thai baht, the Korean won, the Brazilian real, and they lump all these emerging markets into one. Now, as you can see, there's actually been a reasonably strong correlation since January, and then what that's actually shown us is that the Australian dollar has been a proxy of emerging markets. So rather than trade emerging markets, which can be quite expensive if you look at the spreads, people have wanted to trade the Aussie dollar as a proxy for that, and you can see the strong correlation between the two. And I ask any people, how many people out there had been trading the Australian dollar as a result of believing this was a proxy for emerging markets, and there was a strong correlation with the inverse correlation between the Australian dollar and the US dollar and the US dollar and the Chinese yuan. So when the Chinese yuan was weakening, we saw the Australian dollar down on the idea that the exporters in China are effectively losing purchasing power, and that was obviously bad for Australia, where 35% of our exports will go to China. So yeah, they're losing purchasing power because a lot of these exports are priced in US dollars. So how many people were actually buying the Australian dollar or selling the Australian dollar as a proxy of being EM? I'm sure there's a few out there who are, but some who weren't. Then we can go into yield spreads, and we can use swap spreads or other sort of interest rate products, but I've just used here the differential between the Australian 2-year government bond and the US 2-year government bond. And when you see this going down, effectively the yield on the 2-year US Treasury is going up far more aggressively, and this is becoming a more negative number, which means that if obviously the 2-year US Treasury encapsulates interest rate expectations, inflation growth, and everything that around that. And that's been widening relative to Australian government bonds, and we've seen the reaction there. So as this goes down, people are seeing more upside valuation in the US dollar. So how many people are actually looking at yield spreads? Now, if you look at how all of these various factors play into that, what I do in my system, and it's a time-consuming process. If you're a plumber or a farmer or someone who has another job, a real job, then you're not going to have the time necessary to have that. So when we talk about trading being specific to you as an individual, my job is to come in here and look at financial markets and look at opportunity and devise playbooks around that. Your job may be to fix someone's chimney or go and work on a farm. So you might not have that situation. You need to create a trading program that fits into that lifestyle and is specific to you. Now, if I look at the bond spreads here, that's something I can look at. I can have a range of different models and actually see what fits and what is correlated. And if you look on the right-hand side, this is an example of something that a lot of institutional funds will do, and they will actually create models, and they will look at the sensitivity of a currency to these various fundamental factors and say, like, how are yields going into this, the yield differential, interest rate differential, terms of trade, volatility measures, and they will actually go through and see the sensitivities of the currency to each one of these at any one time and weight their model accordingly. And what you can see here in this grey section is Westpac's fair value, and Robert Rennie, who I actually took this off Twitter, is definitely someone you should be following because he puts this out every week. And you can see the red line here is this Australian dollar relative to their fair value. So what does this mean? It means that the Australian dollar is cheap relative to these to their model. Now, that doesn't necessarily mean that I'm going to go out and buy the Australian dollar just because it's cheap. It is a consideration for me of a larger strategy. So I might go out and say, I want to have a look at positioning, which I can have a look at the weekly commitment of trader or CFTC report and say the Aussie's really short, everyone's really short Australian dollars at the moment. I can say, what are the technicals? And for me, the technicals are everything. What is the price action there? So I'm looking at a cluster or a confluence of various considerations that play into my risk reward trade-off. And this is just the execution of a trade that I have in my system, my structure. When the technicals and the fundamentals are misaligned, you respect the technicals, pure and simple in my mind, because we don't know these things that are happening in markets, and the price action will reflect how people are feeling about what's going on. Price action is forward-looking; it reflects what people are thinking about in the future, and it's just a dot on a roadmap there. So, I will look at this model, and this is something that a lot of institutional traders will have. They will have these fair value models. And when it becomes too much aligned, maybe 2 standard deviations from their point, they will actually wait for the technicals to do it, and they have to look for convergence between the two. But it's part of a larger term consideration. So when I talk about fundamentals in trading, these are the sort of fundamentals that the professional traders will look at, and they will have some very, very sophisticated trade models to actually look at that. So my advice to everyone who's starting out is forget about the fundamentals. It's great to have a view on what the Fed are going to do. It's great to have a view on what's going to happen with Brexit. It's great to have a view on what's going to happen with the Italian negotiations. But when the market's telling you to do something different, the market's never wrong. You're wrong, and you need to adjust to that technical situation. So have a really strong understanding of technical analysis. Have a really strong understanding of price action analysis, more so price action analysis, because I think that's really good. Whether you're a pattern trader, whether you're trading using an expert advisor, which I think it's a great way to trade. I don't use it myself, but if you can create an edge and a statistical edge there, it's fantastic to use. Or whether you're using fundamentals and are trading with a technical overlay, which is how I trade. There is no one bad thing, but if you're starting out, just be cognizant of the fact that when you're trading off fundamentals, a lot of the time it's priced in and you're actually looking at completely the wrong thing in the market at any one time. So that's why I'd always say, back the technicals and not necessarily the fundamentals there. Okay, so I've taken a little bit of time there. 10 steps that you need to ask yourself. Always ask yourself, what are the objectives of a trading account? Whether you've just opened an account with Pepperstone or whoever your broker is, or whether you are thinking about doing it, or whether you're a seasoned trader, what is the objective of your trading account? My objective for me is to grow the capital in my account. That's what we do. Yeah? You want to be profitable. You want to make a second income. You want to make this as your primary income, but you need to grow the capital in your account. But you need to do that in a specific way. Now, I don't think there's anything wrong with people opening up an account and just having an absolute punt. As long as they can admit that they are a punter of markets. I'm just doing this because I have a gut feel that the Aussie dollar's going up, or the euro dollar's going down, or the Dow's too oversold. But that to me is not trading. You don't have an edge over the market in that situation. If you think about, it gets used a lot, and I use the analogy of the casino model. A casino is there to get as many people through the door as they possibly can. They plow you with drinks to make your inhibitions disappear. But they have a statistical edge over each game. And whilst I might win $10,000 and Robert might win $5,000, they know statistically that the next few people are probably going to lose money. And they need to get as many people onto that table because the sample of data that they have gives them that statistical edge. If you're a punter, that's absolutely fine. But as long as you can realize I am a punter, if you want to become a proper trader, you need to put the effort in. You need to survive for the first couple of years, and then you need to actually take this really, really seriously. But the objective of your account is to take this seriously, to improve and grow the capital in your account, and always manage the risk around your position, whether you're cutting that position early, moving your stop loss up when technicals tell you to do so, but you're a manager of risk. First and foremost, you are a risk manager. How much capital should I have in my trading account? We've talked about that a little bit, in terms of how much you start with. Whether, as I say, there's nothing wrong with having $500 in your account, having $100 in your account, having $1,000 in your account, opening up a demo and starting with that. But just be cognizant, and I'm not trying to scare anyone away from having that amount of money. But the trick is, if you are going to learn a strategy, that means that you are going to have an element of money in the market at any one time on each trade, that may be a percentage of your portfolio. And for the record, the way that I assess this is actually based on the volatility in the position, rather than come out and have a set 1 or 2%. I think that's a great way to learn. But for me, adjusting my position size and the amount I'm going to take on based on the implied or historic volatility in a currency pair or in a market is a really good way of thinking about things as well. But one of the things with having a $500 account, as I keep saying, is the human emotion takes over when you've had a run of wins and you ramp up your position size, and everything goes out, and invariably that's going to be the losing trade, and you're going to say to yourself, well, I'm going to keep holding that position. You run your losses and you cut out of your position too quickly if it's profitable. So there's nothing wrong with having a small account size, but just stick to that discipline. If you're going to put a percentage down, just keep with that and work with that. How does trading fit into my personal circumstances, lifestyle, and personality? Well, I can come out and see each and every person in this room right here, right now, and give you a trading plan. But that's rubbish. It doesn't work like that. It absolutely doesn't work like that. Your job is different from mine. I have a family. I have 2 children. I have a dog. I have a wife who's very, very good at being a wife, being a mum, should I say. and she makes my life very easy. But I also sit here behind a desk, behind a Bloomberg terminal, looking at trading opportunities, looking at flow, talking to other people in the markets constantly. My situation is very different from every other person's in here, I'm sure. And the way that I think about markets and manage risk and manage opportunity is very different from anyone else's. So my trading plan will be very different from someone else's. That trading plan, how much time you're in the market, how many trades you're doing a day, will be down to you. If you're a farmer and you're out on the fields all day, you're coming out for the muster, then you've got to have a strategy which means you maybe have a longer term time frame. You're not checking on markets every two seconds. Can everyone hear me? I've got one person saying they've got no sound. Anyone else? No sound? No? Hello? Audio's fine? Good. Okay. Apologies for the sound. We'll try and see if we can find a better way next time. Okay, cool. So yeah, you've got to have something that is really specific to you, really specific for you. And that's what we need to do. We need to get you to a point where you have a trading plan which fits into your lifestyle. You're in the market for as much time as you want to be, and you're comfortable with. But you have an edge. You're going back and reviewing that. Can I and should I trade multiple trading strategies in one account? Well, yeah, absolutely. Hell, absolutely. I do. I have a mean reversion strategy where I think something's become too far away from a fair value. That fair value is difficult to achieve. Maybe you want to use Robert Rennie's fair value, but you want to do that over different currency pairs as well. I have a momentum strategy. I tend to like to trade things that are strong. I like to look at currencies. I like to, first of all, look at a currency that is the strongest currency, and I like to marry that off with the weakest currency. I think that's a really, really good place to start in currency trading. But I think there's absolutely nothing wrong with multiple strategies, multiple styles in the one account. Absolutely. In fact, you should be adjusting your strategy to the markets themselves. If markets are going sideways, have a look at a way of range trading the market. Well, I'm going to maybe put on a Bollinger Band and marry that up with an RSI and range trade the market and put tight stops either side of that. The market's trending higher. I want to go with the trend. I want to look at swing trading within that trend. If I see a bearish outside day reversal, have a look at the S&P on a monthly chart at the moment. We've seen a huge monster S&P key day reversal playing through in the price. Now that's fine. But we're waiting for the follow through, so the lower low there to confirm that we've seen the highs in these markets. The trading strategy that you have needs to be dictated to by the market themselves and the conditions and the price action you're seeing there. If you are a trend trader, don't trend trades that are not there. Trade trends that are not there. You're going to go and find a currency pair that is trending. You're going to find an asset class or a currency or a commodity or whatever that's trending. If you love range trading, you have a really successful EA that loves a range trade. Well, put that EA on something that's range trading. So that's really it's the market you're trading. Your strategy needs to adjust to that market and the actual situation at any one time. How do I identify opportunity? Well, how do you identify opportunity? That's something that you need to ask yourself. Personally, and I'll talk about that in a moment. I will take a fundamental view based on a key macro thematic and how my philosophy of a market herd behavior trades going into a key event, be it political or for a central bank action. I will look at trying to reduce my exposure around binary events where it could be a flick of a coin. I have no insight. It's 50-50. I can't control that outcome. I want to manage my risk. So maybe I'll reduce my position in that situation. But in terms of identity of opportunity, I take a fundamental view. And if my fundamental view is backed by the market saying, Chris, you've done the right thing, then of course, that's how I look at opportunity. But I'm always looking at what is the event risk for the week ahead, what's in the week for next week. The calendar is so important in that situation. Listening, digesting news and flow, I think is really cool. So that's what you need to have a look at. What is the opportunity, be it technical, pattern traders? If we have the breakout, we have the confirmation, we have the retest. What is it that you do to identify opportunity and what do we do about news and event risk that's genuinely relevant? So I think that's really interesting because, I think the non-farm payrolls is really, really great one there because, so much interest in people looking to trade the non-farm payrolls, and they're looking at the level of jobs that are being created at any one time. And I'm like, yeah, that doesn't really matter. You know, the trend in job growth in the US is fantastic. You know, one bad job number is not going to change the situation. In fact, you know, we're looking very much at the one thematic in the US, which is inflation. What does that mean for bonds? What do high real and nominal bond yields mean for, you know, the discounting of cash flows for equities? Well, it's very bad, and the price of money is being guided higher. So, you know, these are all things that we're looking at. So we're looking at the inflationary numbers. We're looking at the wage data as the most important situation. And how many people are looking at the absolute jobs and trading around that? When you don't actually know the number one key macro thematic, you know, trading around news is often a low probability event. So the best money is made going into the key data releases when everyone, you know, we might get some, you know, bigwig from BlackRock or a central banker talking about something that he thinks is going to happen. Everyone, you know, all the plebs out there like myself come out and say, oh, you know, look at this great view out there, which is very similar to his, and suddenly everyone starts talking and thinking in alignment. And the easy money is to be made when everyone starts thinking the same. You get a herd mentality, and that comes through. Understand the characteristics of each currency. Okay. You have to know, if you're trading fundamentals, especially the characteristics. The yen is the safe haven of the world of currencies because they run a sizable current account surplus. They're a net creditor to the world. The perception is in the world, which is going to pot. The Japanese funds will repatriate money back. So there's a perception element there. The same applies to the Swiss franc. The US dollar sometimes is a safe haven. And then you're going to have the Aussie dollar, which is being portrayed as an emerging market currency. You've got the euro, which has a current account surplus, but we're worried about Italy. Understand the characteristics. You know, the NOK and the Canadian dollar are petro currencies. They do very well because in a rising oil environment or Brent environment, or what we're seeing at the moment where Brent's getting and WTI getting hit pretty badly, and people are worried about the impact that's going to have on inflation in terms of trade there. So, you know, petro currencies, emerging markets. If you've got the risk appetite to trade emerging markets, and you're willing to pay the spread, you know, you can make some great returns on there if you can manage the risk around that. Understand the correct characteristics of each one. So for me, is each currency has their own characteristic. You need to understand that, and then you can use it tactically. If I want to express a view, which is the best currency to take advantage of that view, don't just have to buy the Australian dollar because the world's improving. Do I want to go and buy Aussie yen or Aussie dollar? I'm looking at the best vehicle to express a view, knowing the characteristics of each currency. Or index. I could be trading an index. You know, what is that to do? How do I define my risk and position size for each trade? Correct position sizing is 100% why successful traders are successful. You know, is there high volatility in the market? If there is, you know, we can look at the average true range is a really great one here. So I personally like to look at implied volatility through options. We don't actually offer options at Pepperstone, so we'd be looking at the historic volatility. So we'd look at the average true range. But when you see that average true range, let's say the 5 ATR, you know, going quite substantial, you know, you're saying to yourself, well, I don't want to have my stop loss within that average true range because the chances of getting stopped out are very high because we're trading within the, I've got my stop within the average range, unless I'm, you know, obviously looking for a very short-term trade. So I'll be putting it away from the average true range, which is that average true range is widening. You are seeing a situation where you're taking more risk on if you're putting your stop loss further away. So if I'm taking more risk on, I need to adjust my position size accordingly. So I'm going to take less risk on by lowering my position size. You know, if you've got a market which is a slow grind, often like you see in dollar yen and like we've been seeing in Aussie dollar recently, you know, you are going to look at a situation where, you know, you're going to look at the average true range or the implied vol in the market and saying, well, there's no vol in the market right now, therefore I can, you know, have a tighter stop, and then I'm going to have increased my position size accordingly there. So, you know, position sizing is so important, and for me, the central pivot point of that is volatility, the market's expected range over a certain time, or the historic range over a certain time. So understanding volatility is so key. How can I extract the most out of my trade? When should I choose to close? Well, you know, that question I said earlier, are you trading the P&L? Are you making a profit and therefore you're going to move your stop loss up just to lock in that, or is actually the market moved up? Make time to improve. Yeah, I talked about this before. This is the number one reason why you will be a successful trader, because you will document your trades. You will go and make time to have a look at what's working, what's not working. You'll imitate your life, and therefore you'll cut back on losing positions and do more of what works. You know, for me, I will start with a small position, and when something's working, I will add to that position. How many people have thought about that in their way of trading? So start with something that's small. When the market says, Chris, you're doing the right thing here, add to the trade. If it breaks through a key level, add to the trade. The market's saying that you're doing the right thing. If the market rewards you, do more of it. Okay, so in terms of my process, I'm not going to go to dwell. This is what I think is really important. Continuous improvement, 30%. I mean, these numbers are subjective, and I'm sure people will sit there and go, you're talking nonsense, Chris. But for me, the reason we get better or get worse is because we're improving, we're documenting there. Executing your process. So I've got a plan in place, you know, how I identify trades, how I manage the risk, how I manage the trade. You've got trade management there on the top left. But the actual process of what I've actually set forward to, and then I look back and say, yeah, you've done a great job, Chris. You've stuck to the rules, you've stuck to the plan, you've made money because your system was sound. That to me is so important. Your entry point, well, we can all pick an entry point. Probably more specific to scalpers and really short-term traders, but certainly for me, you know, the entry point, anyone can pick an entry point. It's a random event. Yeah, it could go up, could go down. The entry point's important. You want to get a good entry point, but at the same time, it's how you manage the trade when you're in the trade, which is way more important. If the trade's going against you, you've got to cut out that trade. You've got to cut out that trade. And, you know, you look at a losing client, whether it's, you know, with any broker, and they've lost money over time, and you'll see the same thing over and over again. And it's so hard to do, but you see it every single time, and that is you'll have a small winner, a small winner, a small winner, a small winner, massive loss, a massive loss, small winner, massive loss. And at the end of the year, they're losing money. And you're saying, well, mate, you know, you've got a 70% success record, but look at those losers. You know, you've lost 10 grand there and 10 grand there because you've held on to that position. You say the market's never wrong. The market's wrong if you're losing the market. You're wrong if you're losing money. The market's right. So that you're trading the market is better than you and me, and the market is never wrong. Okay, so I'm going to quickly go to this slide because this is, you know, we talk about, this is something that we look at. And if you look at the left-hand side, the win rate, the math involved here is that if I have a risk reward, if I go into a trade, you know, looking for $1 and I'm risking $50, I need a win ratio of 98%. Now, obviously, not many people are going to do that. But what you can see here, this is the math involved in being a profitable trader. So you can take this away and have a look at this for yourself, because, okay, 50%, if I'm getting 50% of my trades right, you know, I need a risk reward of 1-to-1, probably a little bit more on the reward, because you've got to make up for spread as well. And that's why, you know, that's part of the reason why you see people losing money, is because at the end of the day, there's a spread involved, and that's our commission for you being in the market, and you want to be with the broker that's going to give you the cheapest spread. But ultimately, if you have for me, is, you know, everyone tries to target this win ratio. You know, you go down the pub and you're talking to your mate, and he's a trader, and you're like, oh, what's the first question is you're going to ask him is, what's your win-loss ratio? And to me, that's not necessarily like the most important thing out there. The most important thing is that I have a sample of trades that I can go back and say, my equity curve has done this, it's worked out really well. And then you can say to yourself, you know, how much was I looking to risk on the trade, and how much am I trying to reward myself? And the strategy I might have might not be the greatest in terms of a win-loss ratio. But if I'm going in there looking for 3R, you know, if you look down here, effectively, if I'm going to try and scratch out 3 times what I'm risking, I can get 25% of my trades right. You know, I was in China a couple of years ago, and I was doing a presentation to a group of traders for a well-known broker over there, and I said to them, you know, I trade on my own account, and my success record at that time in 2016 was 47%. And I said, how many people in this room would allow me to manage your money? And they were like, no one put their hand up. Absolutely no one put their hand up. And then I said, well, actually, do you know what? So last year I made 15% before leverage. So if you attach 500 to 1 on that, you know, and if you compare that to the hedge fund managers benchmark, which was at the time about 2%, yeah, I was fairly happy with that. I was fairly happy with the process, how I managed the risk in that position. And if you were realistic, if I was looking to attract professional funds, I would turn around to them and say, the first thing I would expect you to ask me is, how did you manage the risk in that portfolio, in that position? And I'd say this is the step-by-step way of looking how I manage that risk. And then you'd probably say, yeah, okay, fine, you've got a good process. But everyone was so hell-bent on saying, Chris, come back to me when you've got 95% or 75%. And that's where it comes into sort of putting out recommendations for people. I'm not trying to get out for a history of poor recommendations, but when you put out a recommendation to someone, people expect that recommendation to be a correct recommendation, and that's not how you trade. So you go back to that difference that I said at the beginning between strategy and traders. I can come out and say I think the Canadian dollar is going to go up against, or the US dollar is going to go up against Canadian dollar, and you would expect that to be a successful trade. You'd expect it to hit its profit target, but that's not how you trade markets. You're not reacting to that situation. And for me, if I only have 47% right, but if I'm extracting as much out through my trade management as I possibly can, I can, if I've got a 2R, a 2 times risk reward, I only need to get 33% right. So if I'm trying to extract out the most out of a trade, but I'm also got a reasonably high risk reward win-loss ratio, you're going to put yourself on that. If you look at the right-hand chart, you're going to put yourself nicely into that top right corner, which is kind of where you want to be if you're going to grow that capital in your account. So ask yourself, are you targeting a win-loss ratio? I'm sure most people in this room probably are. That's not necessarily the right way to think about things. The right way to think about things is, how am I extracting the most profit out of this, and how am I cutting that loss as soon as I possibly can when I feel that the market is telling me that I'm wrong? And then go back over the data. Let's say you've done 50 or 100 trades, the more the merrier, and actually understand how that win-loss ratio worked. How was it affected by different market outcomes? Was it the currency pair? Was it the day? Was it the volatility? And trying to understand volatility. I've got one question here. How do we understand volatility? Well, that's actually a really good question, because I really want to do a strategy webinar on how you can understand volatility and how you can use it in your strategy. And I will look at the volatility. Now, the first one is, you're going to look at go to whether you're using MT4, whether you're using CTrader, go to the tools and have a look at the average true range. It's what they call ATR. The average true range looks at the high and low over a period and averages out over that set period. I always use the 5-day ATR, and that will look at historic volatility, realized volatility over that period. You can also use optionality, and I like to use implied volatility, which is the options pricing which they put into the Black-Scholes formula, and it gives you things like straddles and market pricing. And we can go into all of that stuff in a strategy. But for you out there, what you have at your disposal is the ATR. Now that gives you, if that it's low, you're telling you the average range, and we use that as a volatility structure is low, and you can use that within your portfolio to understand strategy. If volatility is high, you tend to see carry structures unwinding very quickly. So people love the yen, people sell the high beta currencies such as the Aussie dollar and the Kiwi dollar in that situation. If there's low volatility and positive trending markets, you'll try and pick up the carry trade. So you have a look at what carry structures there are and how that works. There's plenty of literature on there for that. But volatility is key. Whether you're trading your structure in the equity market, if volatility is high, you could try a pairs trade. I want to go long the utilities sector, and I want to go short the energy sector, for example, and do a pairs trade. So there's plenty of ways of trading volatility in that situation. But this chart here is, I think, it's really interesting, because we're talking about the win-loss ratio being so important to so many people, when in fact, actually, it's the overall strategy of getting as much juice out of each trade as you possibly can relative to the risk. So how do I do it? For me, I'm going to go into this really quickly because we're over time now. But the key thing for me is what happens and how I prepare for markets. So on Friday at work, I'll sit there and I'll have a look at all the event risk that's coming through in the next week. Which central bank speakers are speaking? What will they potentially say? Are they a hawk? Will they change to more of a dovish stance? Are they talking about monetary policy, or are they just talking about regulation? What is the key economic data points that I need to focus on? We talk about the news. Which ones of those are genuinely important and which ones are not. I'm trying to find out what my event risk is for the week. I'm managing a risk in my portfolio. I will look at on the Sunday. I will spend about half an hour to an hour going through a selection of charts, mainly from a weekly time frame to start with. to get a really good oversight how things. Sometimes I look at monthly charts. I won't trade off them, but it gives you a really good perception of the underlying, the primary trend, the secondary trend we've got in there, the price action, where the support resistance levels are. And then, I'll probably trade off a 4-hour chart or maybe even a daily chart, but I'll get perception. But I'll go through all of my different charts and I'd say to myself, that's a really interesting chart. I'll put it on my high watch list. I'll look at my current open positions, if I've got open positions, and I'll look at the overall structure of the market, how it feels, and I'll assess the risk event there. So I'm taking a discretionary view. Given news, I'm looking at intermarket relationships. I'm then coming in and I'm having a look at what's priced into interest rate markets, what's priced into bond markets, how are they assessing relative to each other. And of course, that's very difficult for a lot of people out there. But that's how I think about that. I look at implied volatility and historic volatility. I'll look at positioning in markets. We can look at that through the CFTC report that comes out every Saturday for us. That's looks at how various futures traders, be it currency futures traders or index futures traders, commodity futures traders, are positioned. So we'll look at the non-commercial accounts. These guys are the guys who are moving money around really quickly. And you don't trade off that specifically, but I'm trying to work out where there's extremities, where the market's got a really extreme short position in Aussie dollar. Is there a really short position in the pound as we go into the Brexit resolution? What happens to markets? What happens to markets if we get some good news and the market is structurally short, be it through optionality, which we look at risk reversal, so Google that and have a look at those, and also through the CFTC data. And again, I'm just looking at all these big picture situations to look at the risk reward in trading. Now I choose which pair do I look at to best express my view. Again, I understand the characteristics of a currency. So let's say I believe that oil prices are going down. Now, of course, I can go out and trade oil, and I personally think I'll be selling rallies at this point in oil. I think there could be a short-term rally, but I'll be selling that. Now, how do I take a view of that? Then I look at the overall implied volatility in markets. I say to myself, what happens if the S&P comes under big pressure? Tonight we're all hanging up. If you look at the trend there, we're basically hanging on by a thread. How do I trade that? Now, I'd say to myself, well, what's the best currency in times of risk aversion? What happens if oil goes down? I'm going to trade CAD yen from the short side. I'm looking tactically at trading the best currency pair to take advantage of a potential high volatility move. Equity markets coming down. I want to be in the yen. I want to trade that because I think oil prices are going to go down in this situation. So I'm going to be short CAD yen or Noki yen. So you see what I'm doing? I'm trying to fit a currency. Then I lay my currency overlay with the technical charts. I'll look at weekly or 4-hour charts. I'll manage my exposure when I have that trade. I'm looking constantly at how price action's evolving. I'm constantly looking at the news that I think is relevant to that and managing that position, cutting back. If I've got a losing position, and the market has changed, if the facts change, I change. I cut back on those losing trades. Once I've got the position and I've closed that, I will analyze that position. I will document that position. I will learn and I will try and improve from that. And I will rinse, wash, and repeat this whole process. So that's me. That's how I think about that. How do you think about that situation? How many pairs am I trading, Walter? I trade as many currency pairs as I possibly can. My strategy is not to limit it to one currency pair. If you're a scalper, you might just want to trade one currency pairs. The price action you're most interested in, you're trading that structure of the market at any one time. My advice for anyone who is scalping is make sure that do you still take a view of the daily chart and the weekly chart? If it's trending strongly, make sure that is a consideration when you are scalping markets as well. You'll probably find probability favors that you're going to get more up moves than down moves. But take a view there. So for me, it's how many currency pairs do I trade? I trade as many as I can. But I've been doing this a long time. And you need to start simple, understand the characteristics there. And that's great when you've actually got a small account and you're trying to understand the volatility. But I know Aussie yen or Euro yen is going to have a bigger move on a percentage basis, and it's going to obviously on a pip basis than we see in Aussie Kiwi, where you're marrying off two currencies which are leveraged to the same economy or same economic forces and what we call a lower beta move. So I understand that certain currency pairs are going to have bigger risks. If I'm trading Aussie Turkish lira, I know that there's potentially going to be a bigger move than we're going to see in Euro sterling, for example. So, if you go onto I think there's some EAs that you can run through smart trader tools on MT4, which give you not just correlation analysis, but other bits and pieces as well, which you can probably help out with that situation. But you know, I don't think it depends on your strategy. You know, for me, my one is having a discretionary view on the world, and managing the risk around that, but also choosing the right vehicle that fits into that situation. So will I close a losing trade before it has reached its stop loss if you think on Sunday it no longer becomes a winner? Absolutely, I will. 100%. A stop loss there is a stop loss is there to show you how much risk you're prepared to take on. You know, and going back to that point that I said in an earlier slide, where the market's never wrong, you're wrong. And you need to respect that, because, you know, there's so much ego involved in trading, and the best traders are the best losers. People who can admit they're wrong. You'll find people who are making consistent returns with Pepperstone are the guys who are happy to admit they're wrong, and they'll close out that trade. So a stop loss to me represents how much risk I'm prepared to take on. If you go back to this chart here, where I'm looking at how much risk I'm prepared to take on, you know, I'm looking at a natural point. You know, I might look at implied volatility or historic volatility and say, well, I need to have my stop loss this further away, and then looking for a natural point for where my stop loss should be it for a retracement tool, for a Fibonacci retracement level, or for a, you know, a swing high or swing low, or whatever it's going to be. You know, and then I'll work out how much risk, how much reward I'm looking for to get that, you know, to get that win ratio to get myself as a profitable trader. So yeah, absolutely. I will close out of a position. If the facts change, I change. That's the mentality you need to do. If the price action changes and reacts to new news that's coming through, the financial markets are a discounting mechanism. They discount all known news, or at least they think they discount all known news. So if the facts change, you change. If your stop loss is there to protect you against how much risk you're taking on, if you think it's going to, if the fundamentals change, if the technicals change, you get out the trade before your stop loss is hit, in my opinion. You don't move your stop loss closer to the market, in my opinion, unless unless the market's moved up. But we go back to the point: are you trading the market? And, you know, Stephen, to answer your question about a trailing stop loss, I don't use trailing stop losses, because I want to feel out the market at any one time. The market, you know, I'm trying to feel the rhythm of the market. I'm trying to understand how it's working on a 4 or 1 hour, 4 hour chart. Trailing stop losses are great in certain circumstances, but for me, you know, when the market has moved up through a key resistance level, the consideration, probably the bigger consideration for me, is do I add to that position and move my stop loss closer to the market, or do I wait for a close through that level? 9 times out of 10, you will see a fake out. You will see the market trade for a key level. It will have a bit of a stop loss run. Then it will come back to test that former breakout. You see it time and time again, so many times. So for me, if I'm trading off daily charts, I'll wait for a close above that level. And you know, it might go higher than that level. Fantastic if it does. And it's about the psychology. What is the message that I'm reading through that? So if the market closes above a certain level, it could be a former high or a retracement level or whatever it's going to be. You know, it's telling me that if I'm long, that the bulls are in control of this move, and I'm going to add to that trade. So I will wait for the market to close above that level, and then I'll say, right, I might move my stop loss up a little bit. I might even add to that winning position. Think about that. If you're one of those guys or girls who are constantly cutting your profits too quickly and allowing your losses to run, think about changing your mentality and go into the trade saying, if this isn't working, I'm getting out. I'm an honest, I'm a good loser. I'm getting out this trade. But how about thinking about trying to add to a winning position? It's really, really, really difficult to do. I can guarantee you'll find it impossible to do. But if something's working, it's broken and closed above a previous resistance level that you think is really key, or below a former low, or whatever it's going to be, however you look at the patterns, think about adding to the position. Do what more, think about how it works in your life. Try and add to that position in that situation. I mainly trade US dollar pairs, but I'm now getting focused on isolating pairs to express my view. That's fantastic. Taking me a bit of time to learn the intermarket currency pairs relationship. It will take time, absolutely, 100%. The way that I express my view through a thematic, through using currency pairs as a tactical vehicle and applying an overlay around that. Yeah, it takes time to learn that. Of course it does, and you have to be. It takes an element of, you know, spending a long time doing this, living and breathing that, and that may not suit you if you have a life outside of trading, and you know you have a high impact, high life. You know you can't do that, so you've got to do something that works for you, and that may just be pure technical trading. It might be price action analysis, but there was one thing that is constant with whatever you're doing, and that is the ability to cut out of your trades really quickly. And let your profits run, and that's really hard to do. But you know, risk management and position size is consistent through whatever your trading strategy is. What's the best time frame for scalping, in your opinion? I'm not a scalper, Andrew, so I'm not gonna critique on that. But again, that really depends on your time frame and the type of scalping strategy that you're looking to do. You know, whether you're looking for 8 pips and risking 2. You know, you might work off 5-minute charts, but again, you know, if you're going to spend that little time in the market and you're going to, you know, potentially do 50 trades or even more, depending on, you know, that situation, then that really depends on you. But yeah, I struggle to, would struggle to be scalping on anything less than a 5-minute chart for me. You know, I like to get my shit together and actually work out what's going on before I move to the next one and have a bit of time to assess where that risk reward structure is. So for me, you know, and obviously having all your lines, various points of resistance, they're obviously very key as well. So yeah, I mean, whatever best works for you is how, you know, how much time can you spend in the market at any one time, is that situation. Can you explain preemptive positioning or short covering by other players in the market, especially in the lead up to key news events? Yeah, look, I mean, if you look at, okay, a great one's the Aussie jobs number, for example. Absolute lottery. No one has any insight where that's going to be. You often see the actual data point coming well outside the range. It's a random event, although we look at the trend, and the trend has been for, you know, strong job creation. So you kind of use that as your risk reward. Now, for me, as I go into that situation, I will look to reduce any kind of exposures to assets which are going to be sensitive to that data release. So I'll look at Aussie dollar, I'll look at Aussie crosses, I'll look at, you know, potentially if I was running interest, you know, 30-day interest rate markets, for example. Now, I would look to reduce those exposures because this is an event that I have absolutely no control of. Now, in that sort of 5 minutes before, you will see, you know, you will see stops coming through. I mean, liquidity is key. Liquidity is what's causing these big gyrations in financial markets now. As you know, balance sheets are contracted from central banks, and funding costs are going up. There is less liquidity in the markets, and that will impact the ability to get in and out of positions, and the cost to transact will go up as well, especially with high frequency being such a big part of that at the moment. But that is, yeah, exponentially higher when you're coming into that sort of, you know, the business end of a data release, when, you know, people are pulling bids out the market, they're pulling offers out the market, liquidity is getting scarce. You're going to get brokers coming out, you know, looking, you know, big investment banks looking to move prices and try and cut stops out. All these various factors that you hear about, and you know, the big hedge funds will move money around. So yeah, absolutely, for me, you know, trading around announcements is a, you know, it's a skillful art. But it can be done, but you know, you just got to understand positioning. Positioning is very difficult because it's a very untransparent situation. You know, you can look at the weekly CFTC report. You can have a look at, yeah, all these various factors that you see. I mean, I wouldn't use a client sentiment from any of the retail FX brokers, because, you know, you're talking about very small amounts of flow, whereas, you know, Citigroup or Deutsche, or one of the big banks who put all the big flow through and actually sees the hedge funds coming through, the big multi-asset managers. You know, these are the guys who have that upper hand because they get to see the flow all day. Flow is so important in all asset classes. But yeah, for me, if you can't control something, then you will look at reducing it around an announcement. Now, for me, also, when you're thinking of probability, like I might go into a big political event and have a look at all the aspects, you know, optionality, how people positioned, in the CFD futures report, how has the market trended into that scenario, and look at the risk reward trade-off between what's happening there and managing my exposures around that situation. What period RSI do I use? Well, I personally use, if I'm using daily charts, I'll actually use a 9-day RSI. We're still looking for short-term timeframes, but again, I mean, what works for you? What do you use an RSI for? Is it for divergence between momentum and rate of change and the actual underlying price? I think, obviously RSI, stochastic MACD is great for looking at potential divergent moves that you're seeing in there. But I would personally use a 9-day. But an RSI in most cases is so much education on the RSI, and I totally agree that it's probably one of the most misunderstood oscillator indicators out there. An RSI above 70 on the 14-day RSI is actually a really positive situation for me. Especially in currency trading, where you want to be leveraged to the strongest currency or the thing that's going up the most. As long as there's no divergence there, then an RSI above a certain level, 70 for example, actually just tells you something that you can probably already see from the chart, that the rate of change is high. Actually it's probably quite a bullish sign, the amount of times when you see in a strong trend the RSI above 70 or 80 for a prolonged period of time, until you see that divergence playing through. An RSI is something that you're seeing already out there. But yeah, I'd probably use a 9-day RSI. How long should you stay in a trade? Well, that's an impossible question. For me, as someone who uses daily charts or 4-hour charts, I'll stay in the trade as long as it takes. I could be in a trade for 2 weeks. I could be in the trade for a month if I had to. But you're trading the price. I'm not going into a trade with any kind of time frame unless I'm trading options. But for me, if I'm trading just a straight vanilla currency pair, I don't have a time frame in mind. As long as it takes until I've extracted enough juice out of the trade that I so can. I'm thinking about the reward. I go in there thinking about the risk, but when I'm in the trade, I want to get as much juice out of the trade as possible. If the market has some sort of price action that tells me that I need to be on my guard, then maybe I'll manage my position accordingly. But if the market's going up, you are getting as much out of each and every single trade as you possibly can. That's how you get in there. A lot of trend following macro funds, or macro funds, for example, let's not take trend following funds, but a lot of big macro funds that you see out there, FX trading funds, will have 2 massive trades a year, and they're looking for 8 to 10% in that pre-leverage, and that's their return. If they're taking a 2% performance fee, they need those 2 blockbuster trades, because they're going to have a series of small wins and a series of small losses, mostly small losses. And you're going to need 2 massive trades, be it a trend that you're seeing in markets, but you're staying in that trade and you're getting as much out of that position as you possibly can, because you need to beat the benchmark and you need that 2% performance fee. But you're getting those 2 big trades. They need to be 8 to 10%ers pre-leverage, and that's what we're doing. So we're in the trade for as long as it takes. It could be a month, it could be 2 months, it could be a year. Who knows? But we're not going with a predefined plan to get out the trade. We're going there with a predefined plan to how much risk and how much reward we kind of want. So time frames are not important to me in how I trade. Maybe it is if you're a scalper, when you obviously you're waiting on the next candle to come through. But when the market is down and then swaps to a buy, do you take a buy? Derek, that's a great question. Yeah, absolutely. I mean, if I personally would have to think about that, because I like to look at the fundamental picture as well as the technical picture. And if you've read a lot of my research, you'll know that there is an element of both components that come through in that. But if you're a pure technical trader, you've got to trade the conditions. You've got to trade the market swings. You've got to trade what the market's telling you. And if the market's telling you that if you're long and it comes down and you've been stopped out, but then subsequently it's gone, you've got your stop below where everyone else is going to have their stop lows below a significant low or a retracement level, and that continues going. Well, the facts have changed. You need to admit that you're wrong, and actually the market's changed trends. And yeah, you can absolutely square and reverse in that situation. It's going to take me a little bit longer because I want to actually understand why, what's going on there, and I'm wrong from a fundamental perspective, but the market's told me that I'm wrong, and therefore I need to work out how much I take an assessment as to how much further that can go down. But if you're a pure technical trader, yeah, absolutely. If the market trades through a previous low and looks like it's going to close there, then yeah, you're going to change your position and change your mindset to that. What's a simple watch list for home traders to get a pulse on the markets? For me, I track 7 US dollar pairs, and I've been finding it hard to track and understand bond yields, equities, commodities. Yeah, I mean, absolutely. I mean, I talk about bond yields all the time in my market wraps, because they are absolutely so important. I mean, if you think about how the world works, currency markets are capital flows going from one place to another. And the price of money is guided by the returns that you can get in different countries. And of course, if I'm sensing that I can get a higher yield in the US relative to Japan, then the Japanese fund's going to go out and you look at the returns. Now, of course, and so we get a return in the currency market, you get a return from the bond market. If I can get a 3.2% nominal yield for 10 years in the US, now if I inflation adjust that, which of course is what we call real yields, then I'll get 1% return. Now, a Japanese fund would then have to think about how they hedge that exposure, and actually, if they hedge, the hedging costs are very expensive. So you would actually do that unhedged, and therefore you will not neutralize that currency exposure by buying back yen. And again, that's something we'll probably talk about another time. But if you look at the returns that you can get in other markets, this is the valuation of a currency. So if I looked at in Europe, I can get X return, and if I look at what I can get in the US is 150 basis points or 250 basis points higher. Of course, the US dollar is going to be the stronger two currencies, because but then it changes on a relative basis. So the bond market is about returns, and it's about investment flows into those currencies. If the higher the return in the bond market, the more attractive that currency is. So bond yields are absolutely key, and we talked about that in the modelling, where there's a close relationship there. So you got to think about the capital flows and investment managers, real asset managers, and the potential returns they can get in those currencies if they're hedged or unhedged. And that's just the way that bond markets works. And bond markets also reflect interest rate expectations. If relative interest rates are going up in the US relative to Australia, then of course it's going to make the underlying currency more attractive. Volatility is such a key. If volatility is high, then how does that work for that as well? So it's very difficult, but until you get a firm understanding of bond markets, I talk about them a lot because they are really important. Equity flows as well. We saw recently a fairly big decline in the Nasdaq and the S&P, and there's a possibility it may continue to fall down. And we actually saw people coming out saying, the US dollar should be a great buy in this situation. It's a safe haven currency. But we actually saw the US dollar weaken a little bit. And my view there was that we've seen this huge concentration risk where, a lot of asset managers have been very long US equities because they've been the best performing asset class out there. And they've had this huge concentration risk, and effectively they've been buying these assets unhedged. So they, if you're an Australian fund manager and you've decided to go and buy, Tesla, lo and behold, but let's say you go and buy Apple, you have a currency exposure. Now you can go and hedge that currency, and that's expensive to hedge US dollars because of things called cross currency basis swaps has been quite expensive. To neutralize that currency, so you leave that currency unhedged. So when you sell the equity, then you might want to move that money back to Australia or back to Europe or back to Japan, and that's where you see the currency flow coming back in. So when we saw the S&P coming lower, we saw people that concentration risk of international money managers unhedged taking their money out and actually reverting back. So it's a great question about the watch list. For me, I'm very lucky. I've got a Bloomberg terminal. It costs about 25 grand a year. But there are ways about doing that. Actually, that's a really good question. I would have to think about that one in a bit more depth. Obviously, there's a lot of things that fixed income products that a lot of brokers don't offer. So maybe that's something that we can look into in future webinars, how we can actually get that and how we can create a good workspace and a good monitor to get us thinking about those various factors. I'm going to answer one more, and then I'm going to have to get back. If US dollar sterling is a sell and Aussie US is a buy, does this mean that Aussie should be a very good buy? Great question, Derek. Yeah, I mean, I think if you're looking at three different currency pairs, two with the same currency, then yeah, you've got to keep it simple. And you are going to see those cross rates will be affected by those two currencies. So yeah, you're going to trade the cross. So for me, I trade crosses all the time. I think crosses can be fantastic because the thing with currency crosses, if you're taking the greenback out of the equation, a lot of the time you'll actually take a lot of the macro out there. Taking the Fed out of the equation a lot of times can make life really, really simple, because the Fed are just the all-encompassing, all singing beast. Everything dances to the Fed's tune, or Donald Trump's tune to an extent as well. So yeah, absolutely. I think if you can trade or the crosses, that could be a really good way. But of course, yeah, the crosses are priced off, what the majors are pricing at those times. So yeah, absolutely, that's very important indeed. Yeah, it should be a good buy in that situation. So I trade sterling, Aussie dollar all the time. But again, I look at that's a reflection of the Australian dollar being a vehicle for emerging markets, which we saw in the correlation chart. It's effective that the pound is effectively a political currency. So understand the characteristics of a currency. Is it a political currency? Is it a cyclical currency? Is it a risk safe haven currency? Is it a current accounts currency? These are the buckets that I like to put them in. And the pound is a political currency. It's based on the idea that economics doesn't matter in the UK right now. In fact, economics in the UK is actually not too bad. They've got unemployment at a decade low. They've got wage pressures above 3%. But it's all about how Brexit turns out. If there's no deal and we get a cliff edge scenario, then of course we're worried about how the UK looks, and there's going to be concerns about the M25 being backed up as the port's shut, and the army basically coming around and handing out rations and talking 52-week days later, those kind of stuff. So economics don't really mean much when you've got a political currency. It's about what the future will look like under that change in political circumstance. The Aussie is a cyclical currency, so we're looking at how data transfers into higher interest rates and various factors as well there as well, and a risk on environment. How does that impact the consumer and the feedback loop there is? Anyway, I will leave it there because we've gone a bit over time. I think so. Thanks for everyone who's watched today. I will say that if you're not already on my daily that goes out around 3:30, 4 o'clock, there's the link there. Write that down, and you can go there and sign up to that. They'll get sent through this video complex, so you have to listen to my dodgy white boy English accent on a regular basis. But that's something that you might look at. The guys here as well, there's a bunch of guys who are really interested in trading, and they put out some really good recommendations, and we're going to be monitoring those, taking accountability of those recommendations if they're bad, following them up if they're winners as well. And that might be something that you want to sign up for going forward as well. And look out for more webinars from me going forward. We're going to talk a lot more about your education, strategy, going through the platform and various factors. But the whole point for today was really to get a firm understanding about how the things that I've learned over my time, the things that have made successful traders, things that have made less successful traders, and why people go bust doing this. But as I said, the most important thing is survival at the start, and actually having some skin in the game and learning from those lessons, and being humble enough to learn from what's not working, what's done. So I thank you all very much for coming. If you've got any questions, I think there was a help desk number on the on the actual form that you received, the registration email that you would have received. So if you've got any feedback, anything that you think I could have done better, or obviously give me a pat on the back if you like as well, then please do feedback. We're always trying to make better education here at Pepperstone. So if there's anything that we can do better, please let us know. Please follow me on Twitter as well. If you want to have some banter, then I'm on there as well, so that'd be good. But for us, it's really important that we give you guys the best education, the best start. So if there's anything that we can be doing better on that side of things, we'd love to hear. And if there's something that you think is really good and we could do more of, then please hear about that as well. So thank you all for your time. I appreciate giving up your Wednesday night and we look forward to seeing you guys again. So thanks very much.